All right, wow, this is absolutely amazing turnout for the first talk of the year here with Link Local Marin, and I'm really proud to have everyone here today. It's very exciting for us to be able to talk about the upcoming tax. I'm not going to say cuts. I'm not going to say cuts. In fact, I thought that there might be a bunch of people here with torches and pitchforks. We should have handed them out at the front there. Yeah. Just first thing I want to make sure is that nobody here is. I wanted to check to make sure that nobody is parked in the lot in the back. If anyone is parked in the lot in the back, please move your car. There's plenty of parking over at Northgate, and you need to be parked at the Northgate Mall or across the street from here, so that you're not parking in any of the parking spaces here. And just wanted to welcome you all. Some of you, I think, are first-time attendees to Link Local Marin and our Lunch Brown Bag Speaker Series that we do on a monthly basis here. We're doing them on a quarterly basis here now at the Marin Builders Association. And thank you so much for having us here. And then the other 8 slots that we're going to have will be over now at 165 Redwood. That's right across from the where AAA is over on Smith Ranch Road. The Redwood runs right behind there, and there's a business complex that's just right on the left side. And we're in the conference room. We'll be doing our other talks there in the conference room there for the other times of the year. But we'll be doing quarterly talks here. We're trying to have the big talks here in this room, and obviously this is one of the big talks. So just want to let Christine have a moment here and talk about the Marin Builders Association, how great we are. It's just fantastic that we've maintained this partnership over 2 years and been able to do these talks here. So why don't you have a moment and just talk about what's going on.
Thank you very much. Hi everybody, my name is Christine Puccini and I am the Director of Member Services and Business Development for the Marin Builders Association. Many of you have already heard my spiel, so my apologies, but I see a lot of new faces. And kudos to you guys. This is obviously a hot topic and a wonderful forum for a great meeting. So cheers to all of you for making it out here in the rain. A couple of housekeeping items for you before we get started. Parking. Unfortunately, the parking area in the back is reserved for our tenants. So if any of you have parked back there, I do need you to take a minute and move your car. We ask that you park at the parking lot over by the Northgate Mall. Restrooms, you pass them on the hallway, in the hallway on your way here, so that's where those are located. Emergency exits, not going to need them, but just in case, there's one over there, and then there's one behind those 2 doors over here, so you all have other ways to exit. We are so happy to have the partnership with Brown Bag Local and their Brown Bag events. It's a wonderful way for us to connect to our local community, which we dedicate to. What is Marin Builders Association? Well, for those of you who don't know, we are a not-for-profit. We serve the local construction industry and all associated businesses. We have been in existence since 1958 and have a very rich and powerful legacy and history in this county. We dedicate to 4 basic areas: industry, advocacy, education, and community, and we dedicate to the value of our membership. We are an excellent resource for you. Even if you are not a construction or a local builder or an associated business, we have a wonderful publication called the Marin Home Resource Guide that we put out every year. I feel free to take copies of it. It's located in the back. We are already in process for the 2018 version, which will be coming out late March, April, early April. We try to get it out around the county, but feel free to drop into our office to pick it up. It is a great resource piece for you. And in the back is a printed directory of all of our members who are dedicated community folks, local, licensed, hardworking, that we would love for you to think of as you're doing improvement projects in your businesses or in your homes. We have a phenomenal new website called marinbuilders.com. Again, another great resource for you. You can also find our online version of the directory listed there as well. If you are interested in learning anything more about us, please take my card, give me a call. I would love to sit down with you and share some more information when you have time. There is a piece that you can also grab back there called Why Join. It just kind of bullets all the different values of membership with us. This room is also available to rent. You do not need to be a member to rent this room. So there's a facility brochure if that's of interest to you as well. And one more thing about the resource guide, there are advertising opportunities in that piece. We make 20,000 copies, 15,000 are direct mailed. You do not need to be a member to advertise in that, and there's a media kit in the back, so there's some information about how to who to contact for that. Again, thank you, and welcome to Marin Builders, and on with the show.
Yeah. I'm going to introduce the person who helped organize all of this, and that's Bob Bednarz, and then you'll have an opportunity to then introduce the rest of your panel. Thank you very much. Bob, take it away.
All right, thanks, Russell.
It doesn't seem to be working, but you can
Is the
try.
microphone working? Well, you know, it's not on, that's why.
No, I turned it off, but
okay.
I don't think it was working.
Can everybody hear me?
Yes.
All right, good. We don't need it. Hopefully you guys can project too. So anyway, it's a powerful topic, and I'm really excited to have you here about what was billed as a Republican tax plan. Technically, it's called the Tax Cuts and Jobs Act. The name of it's a debate for another session. We're just going to talk about how the new changes could affect you and your lives, your business. And to do that, I have 4 panels of experts that I'm really proud to join us to give us some insight on this. First is Susan Haase. She's a CPA. She owns Peninsula Accounting, and she's had over 35 years of accounting experiences. Owns 4 offices across California, and she's going to be opening an office soon here in Sausalito. We have Kathleen Nemetz. She's a financial certified certified financial planner, practitioner. She's from McClure Capital, who served discerning investors since 1985. She's also host and producer of a local Marin TV show called Women on Money. Women on Money. This is not a Me Too movement. Among her specialties are working with clients who need to restructure because of a life change like marriage, divorce, serious illness, or retirement. We have Colin Kelley. He's an estate planning and trust law attorney. He's partner at Kelley and Farron, LLP. They're based here in San Rafael. Their practice is focused on estate planning, probate, and trust law. And finally, to round out, we have Anthony Trias. He's also a certified financial planner with Stonebridge Financial Group. That's where we're going to have our next presentation next month. And Stonebridge has been serving Marin County for over 40 years, providing comprehensive financial planning, asset management, and wealth preservation strategies. So to get us started, I'm going to have our CPA, Susan Haase, give us a little 5-minute intro on the topic, and then go into some questions from me, and then we'll take questions from the audience to round it out at the end. Susan?
Hi, everybody. When I started in this profession a long time ago, a friend told me, you really shouldn't be a CPA because they're going to simplify the tax law and you'll be out of trouble. Didn't faze me too much. I figured I'll just do something else, you know. But it turned out to be not true. And every tax law I've been through since then has complicated more than simplified the tax situation of most taxpayers. I don't think this one is any exception. The law itself is only 3 weeks old. We don't totally understand what the 1,000+ pages all say. The IRS now has to go through a period of trying to implement the law through their forms. That's another process. It's going to be a long time before we have a full understanding of everything that's in it. But I'm going to try to hit the highlights for you quickly, and then we want to get to your questions, and we have a lot of other good people here who can add valuable input as well. From what I have read, in general, there are 3 big picture items with this bill. The first is that businesses are helped more than individuals are. That's pretty clear. The second is that the wealthy are helped more than the not so wealthy, based on the way the rates are structured and various other features of the bill. And thirdly, it's generally believed that the law will increase our economy, make it run a little bit better. Probably about 1.7% is kind of what I read mostly. But many that the offsetting deficit increases will eventually pull that down, within 3 to 5 years. So, who knows? Who knows what will really happen? But let's talk about some of the changes. First, business changes. The rates for C corporations have gone down tremendously, from 35% to 21%. That's why it's helping businesses so much. They've also thrown out some incentives for Fortune 500 companies to bring their money back from abroad. So some of the bigger companies have been stockpiling money, and so they because they have to pay so much tax on it if they bring it back. So there's some of that going on. The corporate AMT has been repealed. Alternative minimum tax is a different way of calculating your tax if you've done too good a job of taking deductions. And so that is repealed for businesses, but not for individuals, although the threshold has been raised. Next, the non-C Corp businesses are thrown a bone too, since the C Corps are getting such a big rate cut. They're going to get a 20% deduction of their taxable income when it flows through to their personal tax returns. I'm talking about LLCs, S corporations, and sole proprietors. It wasn't clear to me at first whether sole proprietors were included, but they are. So if your business is on a Schedule C, or you're an S corp, or you're an LLC, you will be eligible for this 20% reduction of taxable income when it flows through to the personal tax returns. I'll just take a second here to say though that there's still question about who got the better deal. And it depends on your tax rate personally, the amount of money you're talking about, and some other factors. So if you're wondering, as I think many of my clients will be, whether your S Corp should be moved back to a C Corp, or your LLC maybe should convert to a C Corp to take advantage of the 21% rate, I think you're going to have your tax person run a projection for you using your specific numbers to make that decision, because it's not clear and there are too many variables to know whether it's going to be good for you or bad for you. But in the long run, though, you still get the 20% reduction, even if you're not a C corporation. There have been some changes to depreciation, most of them good. Section 179, where you can write everything off the first year, has been raised to $1 million. Luxury automobiles, finally, you can deduct your $90,000 Mercedes at more than $1,800 a year. And because those were the luxury auto limitations previously. So that helps a lot. You don't have to keep it forever. They've increased bonus depreciation as well. Some, however, some deductions have gone away for personal and for businesses. Meals and entertainment, gone. Club dues, gone. I thought it was already gone, but it's more gone now. Also, the domestic productivity credit, which might affect some builders, has been repealed. But on the good side, there is a new employer credit for giving family or medical leave to employees. If you pay at least 50% of their salary while they're off, you're going to get a tax credit for that, which is a good deal. And it's about somewhere between 12.5% and 25% of their wages paid during that time period. And that depends on how much you give. If you get 50%, it's still on there. Alright, so that is very quickly the business side. On the individual side, we've lost personal exemptions. Each of you gets, or this year, for 2017, you get an exemption of over $8,000 for each person in your family. Deduction from your taxable income. If you have a big family, that adds up pretty quickly. But those are gone now. They're not doing that. Instead, they're raising the standard deduction for a married couple to $24,000, for single to $12,000, and for head of household to $18,000. So, and again, it depends on your situation whether that's good or bad for you. Other things that are gone are moving expenses, deductibility possibility of alimony, not alimony itself, but the ability to deduct it. That doesn't start till 2019. As far as I know, almost all these things start in 2018, but there's a few that don't. Alimonies. They've taken away the penalty for not having health insurance, part of the American Care Act. Yet to see how that will impact people. General feeling is that it's not very good for the healthcare industry, but that's debatable. Then things that are kept, charitable contributions are kept, but you may lose them because of something else that's gone away, and that, as I'm sure everybody in California knows by now, they are reducing the state taxes and property taxes that you can deduct to $10,000 per year. And that, since we have the highest state taxes in the country, hits very hard here in California. And whether they'll come up with a solution for that, there's a bill in the state Senate right now, Bill 227. You might want to keep an eye on that, to somehow allow you to make a contribution to the state in lieu of state taxes. So if that passes, I don't know if the federal government is going to take offense at that. I don't know either, but watch this space, as Rachel says. Also, the home office deduction is gone, and the things that kept contributions, as I mentioned, student loan interest, they kept that, and the teacher deduction. They fought so hard over that, and that's great. I think teachers deserve the deduction, but they spent way more time arguing about it than it's worth in terms of overall revenue. Because it's only a $250 deduction. For most people, that's $20 in tax. So I thought that was interesting. Okay, things that have changed but not gone away are alternative minimum tax for individuals. The child tax credit has been increased to $2,000 per child under 17. And 529 plans can now be used to pay for private school and private or religious school before college. Mortgage interest has been changed to reduce the limit from $1 million to $750,000 mortgage. If you have $1 million mortgage now, starting in 2018, you'll only be able to take 3/4 of your interest, because the other you'll go up to $750 going forward. And home equity loans are no longer deductible. And then lastly, the estate tax has changed. It's gone from $11.2 million for a married couple up to $22.4 million, which is good for but most of our clients are $11 million.
Okay, thank you, Susan. So she kind of gave us an overview of what we're going to talk about today. So I have some pointed questions to start us off. Basically, they're either family-focused, small business-focused, how you make your investment decisions, and what she had talked about regarding home ownership. So first, I'd like to ask Kathleen a question. How does this legislation affect families, or more to the point, how does this affect life-changing events, such as serious illness, marriage, or divorce? For example, if alimony is no longer tax deductible, is this an incentive for couples to stay together and try to make things work out?
I'm going to test it. I don't know. Does this work? Is anybody hearing? Yes, it is working?
Good.
Good. Okay. So I'm going to bracket everything I'm saying with a few words that these are the indications that, because you have to understand the tax software hasn't even been created yet for interpretation of this code, and we're still learning the clarifications for each situation that seems to arise here. But based on my participation in a tax seminar 1 week ago, and in a panel discussion over the weekend called Gray Love and the Newlyweds, a lot of these things have been explored already with regard to divorce, for instance, and alimony, and decisions that people make, especially as they get older, about how they couple. Whether they're going to cohabit, whether they're going to be domestic partners, whether they're going to get married, whether they're going to create a trust and manage their relationship legally that way. Very interesting ramifications. But to the point you just raised about alimony, yes, if you cannot deduct the alimony, it may make a difference in how ready you are to divorce, because maybe that's going to be more difficult to finance, to actually get divorced. And maybe you decide to spend more time trying to work things out, or maybe you decide to become legally separated, married but legally separated. These are all different possibilities for people exploring how to structure their relationship. I'm not going to pretend to be an expert in any one of these. We overlap into family law here, we overlap into estate planning law, and certainly the tax person might be the first in line. If we're talking about an economic reason to structure a relationship, where the tax person will be able to weigh in on what the long-term effect would be tax-wise. But from a financial planning standpoint, it makes a lot of sense. Whenever people want to be together in any whatever arrangement it is, it's very important that they talk about what that future looks like together, and they establish a goal, because then everything else will fall into place. Because if you start focusing on, gee, should we marry or not marry, that there are romantic considerations here aside from the economic considerations. There are faith-based considerations aside from the economic considerations. But certainly the tax code has changed with regard to alimony. There's an argument, depending if you own real estate or not, there's an argument of, say you have two houses already, whether you make a decision to keep both houses and not marry, because you get more of a deduction for both houses. But all of these things are they're areas to explore. I won't say that we have definitive answers in any one of these areas quite yet.
Okay, thanks, Kathleen. Colin, the changes in the estate and gift tax rules, as Susan had mentioned, offer a huge benefit to the rich. Specifically, individuals with a net worth in excess of $11.2 million. But what about, how do these changes affect everybody with a net worth less than $11.2 million?
Sure. Well, thank you for the question. Is this working?
Yeah.
So I think the short answer is that people do not have to engage as much in estate planning just to avoid estate taxes. And that was actually the case before this law was enacted, because the threshold was actually $5.49 million per person. For a married couple, that was almost $11 million. So estate taxes should be driving estate planning less. And what this means is that people have more flexibility in making decisions concerning estate tax planning, so they don't have to use certain structures just to avoid estate taxes. So for many clients, this means they can simplify their estate plans, and that they can have kind of estates that are easier to administer after someone passes away, because they're not so concerned about structuring things just to avoid estate taxes. So I do think it is a huge giveaway to the kind of the very affluent, but the benefit for everyone else, I think, is that you have some more flexibility when it comes to how to structure things like a living trust.
Well, thanks, Colin. So in planning for, life planning, Anthony, from an investment standpoint, what are the effects of reportable sales of life settlement transactions? For example, cashing out somebody's life insurance policy. It was big during the AIDS crisis, and I'm sure it's still going on now. How does that affect people's decisions?
Right. There have been slight changes with the way that life settlement has been reformed. First, just want to go back to what is commonly known for life insurance, which is a death benefit that's tax-free. But for wealthy or executives, life insurance is known as a supplemental retirement vehicle, where one can benefit from generating cash value, benefiting from tax deferral, and withdrawing as a tax-advantaged vehicle. Usually you see this in Section 162 or non-qualified deferred comp plans for executives. So fortunately that hasn't been repealed. You still have the ability to withdraw FIFO. You still have the tax deferral benefits. But in the situation for life settlement, whereas, for example, you have a surviving spouse who has $1 million life insurance policy, they have $150,000 in cash value, and they have no desire to leave any benefits to any heirs. Perhaps they may come across a life settlement company that is willing to buy that $1 million policy for $200,000. So what has changed is that there's no exemption for a transfer for value rule, meaning that some of these gains will be subject to taxation. This is a bit advanced planning. Obviously, you need to consult your professional regarding that.
Okay, thank you. So Susan brought up a very interesting topic about the 20% pass-through deduction. And I'm just curious, I want to get a quick poll in the audience. How many people here are self-employed as either a sole proprietorship, a partnership, an LLC, or an S corporation? Raise your hand. It's most of us. So, and how many are W-2 wage employees? Or there's a few of you. Okay. So my question to you, Susan, who can take this 20% pass-through deduction and who cannot? And can W-2 wage earners game the system by changing their status to a 1099 entity for a better tax advantage?
Well, everybody will benefit from the 20%. It's for sole proprietors, LLCs, partnerships, and S corporations. So that's a good thing. Now, in terms of the mixing of well, first of all, in terms of 1099, no, that would be against the law because the law says that any business owner, no matter what type of entity, must pay themselves fair and reasonable compensation. Now, they don't define that in the Internal Revenue Code. So then we go to case law to see what the IRS has accepted. And generally speaking, I tell my clients 50-50 or 60-40 profit versus wages will work, or in the case of wages, to a lower amount, depending on your tolerance for risk and whether you think the IRS would approve or not. I always say if you can sit across from an auditor and make your case without laughing, then I think go for it. But if you the law clearly says you have to take some salary if you are a flow-through entity. So whether you're doing guaranteed payments as a partnership or an LLC, or sole proprietors don't have any choice. They have to pay payroll taxes on all of their profits. So my suggestion is talk to your tax preparer and run the numbers for yourselves to see what benefit you might get. You could get a benefit by reducing your salary and putting more into the profits that would be subject to the 20% deduction. But whether you go too low or not, that's the question.
Okay, doesn't sound like the mic's working, so, can everybody hear in the back?
Yeah, I see if I can get it to go on.
Yeah, well, we can try, but I think if everybody's hearing, we should be okay. Okay.
Testing.
Yeah, I think it's the back speakers, so
Sorry.
we should be okay.
Testing.
That's working.
Yeah, you have to really talk into it like you're eating an ice cream cone. Real quickly, Susan, though, can a CPA take the pass-through deduction? Are there certain individuals that can or can't?
Yes, there are certain things that personal service companies cannot do. Okay, there are certain things that personal service companies can't do, but that one they have included personal service companies as being able to do that.
Oh, okay. Are there any service, like, I'm not sure what the professions are out here. Are there any that won't be able to? That's what I wasn't really clear on.
Not that I'm aware of.
Okay. All right, that's good to know. I'm glad you came. I'm glad everybody else is too. Kathleen, with fewer deductions to shelter income, is it even more important now to put money in tax-deferred accounts and retirement plans?
And thank God we still have a few deductions out there, and retirement plans are still there. So if you've been underfunding your plan, guess what? You're going to take a look at getting more money there because it's one of the few areas you can get a deduction for. The other areas, California muni bonds. I brought a few flyers at the back, but we forget about these things, and so we're suddenly thinking about our taxes and opportunities for income later in life. And you have to start doing tax mapping if you're planning ahead for any length of time, tax mapping of your assets to see what the relative tax treatment will be and all the different types of things that will be producing income for you as you're looking ahead to retirement. We didn't bring up rental properties, but I think there were a lot of great deductions offered to people who are landlords. So I don't know, who in the group is a landlord here? Yeah, so we have some interesting opportunities to explore with our tax people. And if you've been on the fence, that might be a direction you look at, because it's tax advantaged income now and in retirement. Retirement plans, if you have a SEP IRA, obviously you can put more money away than a simple IRA. If you have a 401k plan, you can put more money away. And of course, keep in mind, if you have employees, you can't just implement a SEP IRA for yourself and ignore your employees or the 401k. You need to take care of your employees under ERISA law. But as of 2019, the California tax code will kick in and require that employers provide a retirement plan at work. It doesn't mean that necessarily the employers have to contribute, but they do have to structure an employer plan. So that's something to look into. If you have employees, you want to be sure you're on top of that. There is a disparity, by the way, between the federal and the state tax code. So what we're talking about mostly today is the federal tax code. The state tax code remains as it is. There's some evolution going on this year toward conformity, but again, you're going to need to talk to your tax expert on what those disparities will be for your income and your family and your business.
Great. Colin, I'd like to take it back to you. Does the change in the estate tax law make having a living trust more or less useful?
I think that the answer is that most people should still have living trusts, and that this does not change that in any way, shape, or form. As I noted earlier, there is less a need within the living trust to structure things to avoid estate taxes, but there are still a lot of compelling reasons to have living trusts. The primary two, other than estate tax planning, would be for incapacity planning. So if someone becomes incapacitated, the trust includes a successor trustee who would step in and manage trust assets and make sure that bills are getting paid and that things are getting taken care of. And then the other big benefit of the living trust, which continues on after these changes to the estate tax law, is that it avoids probate. So if assets are properly titled in the name of one's living trust, then when someone passes away, they can be transferred either to a surviving spouse or to other beneficiaries like kids, without the need to go to court. And the court proceedings in California for probates are really slow, really expensive, and can be avoided pretty easily by having a living trust in place and having assets properly titled. So that really hasn't changed at all. And the issue really is that, again, the tax planning side of things is less of a concern, but there's still, I think, substantial importance for incapacity planning and for planning for transfers of assets after someone passes away without probate.
Colin, if somebody already has a living trust, is there anything they should consider in recent in changes in the law?
Yeah, I think the one thing I would recommend to folks is if folks do have living trusts is that a lot of folks set things up when the estate tax rules were very different. So if anyone set up a trust in the 90s, for example, the threshold for estate taxes was $600,000 a person. So now we are looking at an individual exemption of $11.2 million. So a lot has happened from the threshold perspective. And that again gets into how do you structure your trust. So you're basically looking at having a living trust when someone passes away, do the assets pass to a surviving spouse, for example, directly, or do they go to a special irrevocable trust for that surviving spouse? And so a lot of folks who set up a trust long ago may have a structure that requires the creation of an irrevocable trust for a surviving spouse that is really serving no purpose given that we have this higher estate tax threshold. So for folks who have existing living trusts, I would say this is a good opportunity to go talk to your estate planner and say, hey, can we look things over and make sure this still makes sense in light of the value of our assets and in light of the estate tax thresholds now in place.
Great. So Anthony, you get a lot of people coming for investment decisions from you. I just have a personal question. Because there's fewer taxpayers will be able to itemize, and because the standard deduction can get up to $24,000, do you think taxpayers will make less or more charitable donations?
Well, I like to think that people who are charitably inclined want to donate to fulfill their sense of altruism and not just for deductions. But nonetheless, there's considerable planning to have a win-win situation. So number one, with the revised tax reform, there has been an expansion of deduction from 50% of your AGI for cash donations up to 60% donations. So again, it's for cash donations. It doesn't apply to appreciated stock. But this might be an opportunity to look into other vehicles such as donor advised funds to accelerate those deductions in one's peak earning years. Essentially, a donor advised fund is a mechanism for one to donate a large amount into a fund in which one could disperse the donations to various charities over time. So you don't have to disrupt any of your charity's fundraising activities. But the individual that makes that donation can receive 100%, assuming it's within the AGI limits, of that deduction. But typically, donor advised funds are an alternative to private foundations and oftentimes more cost efficient for donations that are less than $10 million.
You know, with the cost of education going up, you mentioned we had talked about the 529 college savings plans. So can that be used for more than just college and private schools? Can it be used for elementary or secondary schools?
Absolutely. So that's very close to my heart. I have 2 young children, and it has expanded. The 529 plans have expanded, as Susan mentioned, to be able to use the contributions on a tax-free basis for elementary or post-secondary schooling. This does kind of create a controversy, though, because you think when establishing a 529 plan, the benefits of growth and compounding really are going to accelerate over time, over a longer time horizon. But again, it's a good opportunity to plan because the other alternative was a Coverdell Education Savings Plan prior, which only allowed one to contribute $2,000 annually, and for higher income earners weren't able to make contribution because they were a phase out. So a potential strategy could be to utilize acceleration of donation. So if you're a parent or grandparent and you want to fund your children or grandchildren's 529 plan, you may choose to accelerate up to 5 years of gifting. So in 2018, you could gift up to $15,000 per person without having to pay for gift tax. So as an example, a set of grandparents who have $15,000 each, if they wanted to accelerate the gifting in 1 year, they could effectively gift $150,000 towards their grandchild's education. This might come into play, especially I have clients in the city who, for kindergarten, $30,000 a year tuition, or high school, $50,000 a year tuition. They also have included what they call a 529 ABLE plan. So these plans can benefit individuals who have special needs children. Oftentimes, when you have special needs children, one would develop a special needs trust to be able to save for their children, but also to continue to take advantage of any federal or government funding that's provided to their special needs kids. Through the 529 ABLE plans, those who have maybe a smaller account, it might be more advantageous just to take advantage of the 529 ABLE plans, which allows one to make post-tax contributions, grow their accounts tax deferred, and pay for their special needs child's tuition or education tax free.
Great. Okay, so Susan, now that we have the personal exemption gone, and we talked a little bit about the child tax credits and the 20% deduction on non-corporations, basically, are there any other deductions we should be aware of besides the ones we've been talking about to get beyond the regular $24,000 standard deduction?
Well, it's gonna be tough because, the miscellaneous deductions are pretty much going away altogether, employee business expenses, for example. And unfortunately, advisor fees and tax preparation fees are all gonna be gone. So that's, although they were already subject to a 2% limitation, a lot of people didn't get them, but now they're not gonna be around at all. So the only thing left on itemized deductions is mortgage interest, property taxes, and state taxes limited to 10,000, charitable contributions, and medical in excess of 7.5% of income. So it is true when they say that a lot of people who used to itemize won't itemize. For example, I ran some numbers with some of my clients just to see how it would come out. I took, for example, a family of about $100,000 of income, 4 children. I thought, okay, I want to see what's going to happen with them because they have 6 exemptions, right? It's $48,000 off of their taxes this year, off of their taxable income, I should say, for those 6 people in their family. And when I ran those numbers, it came out that they actually came out ahead because the rates were lower and because the child tax credit, they have 2 of their children under 17, so they got the additional, the $2,000 per child, which kind of offset the loss of the standard deduction and the exemptions. So, I mean, the loss of their itemized deductions and their exemptions. So they came out fine. Then next I did a couple who had no kids and they're like my typical millennial clients who lots of income, no children, and they don't buy a home. So many kids now don't feel like they need to buy a home. So with the state taxes going away, their itemized deductions go away. They don't have mortgage interest. So that means their contributions don't count anymore. And that was an interesting thing to note. But they came out a little bit behind. They owed about 2% more than they would have owed. I took their 2016 numbers because I don't have their 17 yet. And I applied the new law to them. That's what I did. Compared 16 to what 18 would be under the new law. But then I took my very wealthy couple with 4 children also who had $1.9 million in revenue in income last year. And when I ran those numbers, the rate change for them, because the rates are better, the rate change is better for the wealthier people. Many of the middle class people are going to stay in the same tax bracket they were in before because the lines didn't move that much. But they moved really high at the other end. So these guys came out $40,000 ahead.
Wow.
So, you almost have to run the numbers to see how it's going to work. And I know we're offering our clients projections, tax projections for 18 to see, so they know exactly what is going to affect them.
So before we open the questions to the floor,
One more question.
there's one more question. Yeah. So on the home ownership part, I got flyers out there for homeowners talking about the reduction to the $750 maximum and then for the property tax cap and state tax cap at $10,000. So it's on your sheets there. And Kathleen, because you talked about investment property, and since Donald Trump made his money making commercial and real estate investments, what's the status? I mean, is it everything the same, or did it make it better for himself?
Investment properties are going to be favored under the federal tax code, the way I have read this, because they're going to, any net income you're realizing, first of all, you can write off repairs right away. You can write off improvements instead of amortizing over a long schedule. You can take a deduction right away. Like, for instance, if I buy a washing machine, I have a rental unit. If I buy a washing machine, I can take that the same year. I don't have to take it over 5 years.
On rental property. Is that what
On rental property. So that's huge for people who are landlords. And they also can deduct 20% of their net income from tax before it's taxed. That's huge. So predictions. Based on my reading of the loss of the HELOC, I think a lot of people might be seeking out the mortgage bankers in this audience. I don't know who's a mortgage banker, but because you're going to want to fold your HELOCs into your primary mortgage so you can get a deduction. So that's going to be a trend. Real estate prices in this area, I think will probably stay the same because there's such a pent-up demand for real estate. We've lost housing stock from the fires. But statewide, I would expect real estate prices to come down because people have lost deductions that they count on to qualify, to own those homes and to maintain the cash flow and to finance the rest of their lives. So I would expect an adjustment statewide in real estate values. In short, I mean, we're looking at indications at this point. We don't have definitive answers yet.
Thank you. So I'm going to open it up to the floor. Does anybody have a question?
I'm not sure who I addressed this to. I think I addressed it to you. The home office deduction is going, but that's for individuals who are itemizing, right? If you're a Schedule C, you still have the home office deduction and you still can deduct your CPA fees. If you're a Schedule
You
C.
could probably still deduct your CPA fees on your Schedule C.
But not your home office.
I believe home office is gone for everybody. I could be wrong, but,
I can just, okay, to the rental property, is the limit on property taxes included or is it excluded?
it's excluded. You could still deduct your 100% of your property taxes on your Schedule E because it's a business. That's the difference.
Okay, the gentleman in blue.
On the AMT, is there an easy way to figure whether you're going to hit the AMT or not?
I think you'd have to run the numbers. I mean, the limit has been raised. I think it's raised by about 30,000. So if you were at the lower end of AMT last year, you may not have it for 2018, but it's still there for individuals, not for businesses.
Back to the Schedule E, the rental properties. Do you think that applies to owners who only have active participation, or is it everybody who has a Schedule E rental property?
I think it's passive and active. I haven't seen anything that separates the two in terms of the law. But that may be one of the things that the IRS will push back.
Right.
And that's the kind of thing that the IRS might come in and say, wait a minute, this is not an active business, that's different. And people who are passive should maybe, not get that. But I haven't seen anything, there's nothing in the law that I know of that separates the two.
No more questions? Oh, here we go. I got lots if you don't.
I heard City of California, they're thinking of perhaps because of the state deduction going away or the amount going down, that paying more through payroll taxes and reducing people's income and paying more to the I don't know if you read that article about that.
I didn't hear anything about that. I mean, we have an awful lot of people.
Yeah, I did read about that. So this is outside my area of expertise, but
Yes.
yes, but the thought is that instead of having your employer give you money that you then pay in taxes,
Right.
that the employer would just withhold more money, and that actually would end up avoiding the state's, I think, local taxes because that's a business expense when the way they would structure things. So the thought is that's a distinct possibility as a way to try and get the state income taxes kind of re-deducted essentially from people's returns. But I think that the concern is that means that there's less money in people's pockets, and they may feel that that's a bad thing because of that. So.
Right, actually it's the same take-home pay, but they would take their salary back.
Correct.
Russell?
And also back to Kathleen's point earlier, that if you do max out your 401k, that will help because they don't collect and they don't get withholding on retirement plan contributions. So that'd be one way to reduce your state taxes, other than moving to Nevada.
Russell?
let's say there's some form of divine intervention and the Democrats actually take over in 2018. And this year in November, the Democrats actually go and take over both the House and the Senate, just as a hypothetical concept. Can these things be reversed before the taxes kick in for the next year, or is it a thing that we're going to be stuck with this for a year and then we're going to switch back to another system a year later, or what's going to happen? What could happen?
Still got a Republican president, so he just
Yeah, you still have the veto power, and it'd be hard to get past that 2/3 or is it 3/4?
You're talking 220, whatever that's what you're talking about.
Well, I'm still thinking 18, but how long will these things be in place? Likely.
Most of them go to 2025, some to 2026.
And the Democrats can't repeal any
They
of
can
that.
repeal, and as long as you have the political power to do so, you could technically repeal anything. That goes for tax laws, it goes for state tax rules. These can all be changed through Congress, but the issue is, practically speaking, the likelihood of that happening seems pretty low in the short term.
How about in the back, ma'am?
Thank you. So as a sole proprietor with a home office, it sounds like the worst position to be in. Are there any deductions? Sounds like none that we should be aware of or we should be tracking.
Well, you still got your office supplies, your rent if you pay, well, you're kind of home office. You can still, it would, yeah, not nice. No, you still got your auto expense, maybe even more auto expense if you have a luxury car. You still got your professional dues, your professional publications, advertising, those are some big expenses that you still have, yeah.
Jim?
If there's one thing everyone can seem to agree on is that this is going to stimulate federal deficits. So I'm kind of wondering with the financial planners, how they're processing this and how deficits enter into the conversations you're having with your clients.
Well, we've predicted that interest rates will be ratcheting up over time, and that changes. If you're really doing the planning we all should do, and you're looking ahead to what inflation rates will be 10 years from now, 20 years from now, as you get into your retirement, you're making appropriate choices of investments that will grow accordingly, as well as locking in some income sources that may also be able to ratchet up more than Social Security will. I think the writing is on the wall for Social Security. We know that they call it chain CPI. The chain CPI is going to be limited. So people who are receiving benefits such as Social Security are not going to see it ratchet up with inflation the way we historically have seen it. So that raises a lot of implications for people in this room. Most of us, I don't know if anybody here is quite yet retired, but we may still be looking forward to retirement, and we're going to have less to work with in terms of a government benefit, which means we have to do more work on our own side of the ledger for ourselves, and put any other assets that will grow over time, and that we should be doing this now, not later, not the year before we retire. Anthony, you might want to interject something there too.
Well, going along with the other question about sole proprietor, perhaps investing aggressively into SEP IRA or IRA, any retirement vehicles. Because when you work with a financial planner, you have to look at the long-term time horizon. As Susan mentioned, over her 35 years, there have been so many changes in the tax code. Even with estate planning, with exemption amounts over the past decade, I mean, that's changed about 4 times for the past 10 years. And these changes, a lot of them will sunset in 2025. I also think for the long-term horizon, and that's really the way that you should view planning. I see the only thing that's permanent in these codes is that they're always going to change it, and that's just what's going to happen.
If you're a 1099 self-employed, is there tax benefits to switch to like a LLC or S corp? And secondly to that, if you have an investment property, should that be under one of those, the tax benefits?
Well, the 1099 part, it depends on what your total income is, I think. Some people on Schedule C's it's like a side job or a small job that they do part-time, and I don't think it's worth organizing an LLC or starting getting a corporation for those purposes, because there's some costs involved, some setup costs, and then there's every year you have to pay $800 to the state of California for the privilege of being an entity in the state. You also have to pay for the entity's tax return, and so there are some things you want to consider there. But for me, the threshold has always been around 80 to 100,000. If you're up in that category, you probably should consider incorporating or becoming an LLC, because the tax benefits outweigh the costs.
Did you mean for Schedule C income or just total?
Schedule C.
Clarification on a note here that talks about a prepayment of taxes. Is the second installment of the 2017 taxes prepayment, is that allowed?
Yes, it is. The IRS made a clarification on that, because the law was not very specific.
Right.
And their interpretation and what they will accept, which is important to know, is that if the tax was assessed during 2017 but not payable until 18, you could go ahead and prepay it, or you could have. But if you're talking about a tax that hasn't even been assessed yet, like 18, 19, no, you can't do that.
Okay, one more question.
This is two-part. One is, on the 529 plan, I read that you can use $10,000 a year, but I wanted to clarify, is that a year or a lifetime? Because it doesn't really say in the code, it just says you can use $10,000.
From what I read, it was 10,000 for elementary or post-secondary schooling. A year.
A year.
A year, correct.
Okay.
And at 529, for college purposes.
Okay.
They could go ahead.
Right. Okay, thank you. And the other one was, you were saying the meals and entertainment goes away, but don't you still get the meals? Yeah, 50%. Yeah, I think you do. But I just.
That's what you got now. You already
lose
got
all entertainment, but you can still get meals.
What I read is that they're really going to scrutinize what they consider entertainment. So I think there's a lot of individuals or entities that take advantage of what's considered entertainment for that to be a legitimate tax write-off. My understanding is you still get the meals, but again,
If you're traveling for business, you're talking
as a sole proprietor, Schedule C.
Another thing you can do is, if you're like giving away Warriors tickets or 49ers tickets,
I'll take them.
call them business gifts, but you can't do that if you're going. Only if you bought it and gave it away. Now this is one of those things that may change, because that is kind of like entertainment, and they may expand their explanation to include that kind of thing. But right now, I think that would still qualify.
Is there a $25 limitation per client?
I've actually been to an audit where they did not care. So I'm assuming they're just kind of looking the other way. Well, it's a pretty good indication of what their policy is, because they just looked the other way. They didn't care. That's a very old law. Very old.
Well, to kind of sum up everything here, when we had the last tax bill changes, it was back in the Reagan administration in 1986. There was a lot of public debate and discussion about it before it was enacted. And it still took about 3 years before people could really figure that one out. So just imagine this 1,100-page bill being thrown at us. So as much as we have all this expertise here, it can change because it's going to get interpreted as we go. So, just stay tuned, stay in touch with your professionals. Please use them. They're just great. Let's give them a round of applause. And now I'd like to give some raffle prizes away. Let's see, Russell, since Christine's not here, would you like to be
Sure.
our Vanna White?
Oh yeah, I'm just as pretty.
I know, we just make sure to mix them up real good.
No problem.
So first of all, I have this bottle of wine. It's a 2003 Cabernet Sauvignon from Lale Vineyards in St. Helena.
And Veronica Champion.
Oh, Veronica, there we go.
Yes, there we are.
Our next prize is, hold on a second, I'll be the Vanna White. This is an excellent first aid kit from the Marin Builders Association. I won it once, and it's got everything you need, let alone, amputation. So,
And Dan Everett's.
Dan, there you go.
Here we are. Hopefully you'll never need it. And just a quick reminder that we'll be doing an evening event in February on the 27th over at the Tuesday the 27th over at the Lighthouse Grill, Harbor Point Lighthouse Grill. I'll be making an announcement on that on Friday. It'll be from 5 to 7 Tuesday night on the 27th of February. So hopefully you guys can come to that. It'll be a wonderful event, and really appreciate everybody coming today. This is really
We have
been
one
a
more
wonderful
prize,
show.
too.
Oh, one more prize.
And don't forget, we've got our first Link Local Marin event over at Anthony's office at Stonebridge Financial on February 20th, just the week before the mixer. So we'll have an announcement about that too. But our final prize is the balloons from our wine winner, Veronica Champion. So the grand prize goes to
Terry Burns.
Oh.
Must be present to win.
There you go. Here she goes.
Everybody stay. That's
Party's at Terry's house.
there you go.
Well, thank you all for coming. I appreciate it. Stick around and mingle if you like.
Sorry.